Welcome. My name is Sandy Hood and we're going to look at the weighted average cost of capital. We're using an example from the Kaplan study text and I've given you details about how to contact me on the first slide. We're looking at question Test Your Understanding 18, which is from the study text. BCO has 10,025,000 ordinary shares in issue. They're currently trading at 155 cents per share, but that's come dividend. An annual dividend of 9 cents has just been proposed, and the company earns an accounting rate to equity of 10% and pays out 40% of the return as dividends. The company also has 13% redeemable loan notes, which have a nominal value of 7 million and are currently trading at $1.05 per dollar. They are due to be redeemed at a nominal value in 5 years' time. If the rate of corporation tax is 33%, what is the company's weighted average cost of capital? Well, from this paragraph, these two paragraphs, we can extract quite a lot of information. So looking at the clues, the 10 million ordinary shares, well, sure, the nominal value doesn't mean anything to us. We want to know what the market value is. So they are trading at $1.55, but $1.55 includes the dividend of 9 cents. So we want an ex-dividend value, so we deduct 9 cents, and that leaves us with $1.46. And if we want to work out the value of equity, then we've got 10 million shares with an ex-dividend price of $1.46. We then read on. The company earns an accounting rate of return to equity of 10% and pays out 40% of the return as dividends. As soon as you read accounting rate of return to equity, that would give you a clue that we're dealing with the Gordon growth model. And here, in this particular exam, just in case you're looking at this for advanced financial management, that wouldn't apply. But in the financial management exam, RE is the accounting rate of return. So we know what that is. We know it's 10%. And also, we can work out quite quickly that the retention ratio, the other part of the Gordon growth approximation, the B value, is going to be 60%, because if we're paying out 40%, we are retaining 60% of our profit. So we can use that to work out G, and once we've done that, we can fit it into the dividend valuation formula in order to be able to find out the cost of equity, which in your sheet is called RE as well, but this is a different RE, I'm sorry to say. And this would equate to the cost of equity that would appear in your weighted average cost of capital calculation. Then further down the page, I've got the company has a 13% redeemable loan notes. These have a nominal value of 7 million. They're trading above that, so we would multiply the 7 million by 1.05 to give us a value of debt. And we would need to complete an IRR calculation to find the cost of debt. Okay, so from here, we can switch to my ACCA Global spreadsheet, and from there, we can see what's going on. And there we have it. So taking the information, $1.55 minus 9, $1.46. That's my value of equity. And looking at this, you can see how you can use the spreadsheet in order to do the calculations for you. And multiplying it up, it gives me a value of equity of 15 million. The 10 million shares times $1.46, well, it's going to be 14.6 million. So if I just press on here, I can just make it a little bit clearer, 14.60 million. Then we use our retention. We know that we are retaining 60%. We know that we've got a return to equity of 10%. Multiplying the two together gives me a growth rate of 6%. Putting that into my dividend valuation model, I've got the dividend is 9 in the current year, and we've got 146 as our value in cents of each share, and we've got growth at 6%. So putting them all together, I've got the dividend value in year 0 times the 1 plus the growth rate divided by the current price, the current ex-dividend price, and then adding on the growth rate to give us 12.5%. So I've got my VE and I've got my KE. Then I move on to my valuation of the debt, and here we know that it's 1.05 times 7 million, so that gives me 7.35 million. And then, because I'm using the ACCA spreadsheet, I don't actually have to do a lot of calculations in order to find out what my cost of debt is. I have to remember, of course, that although we are paying 13%, because we've got the tax shield, we're able to deduct the 33%, so that it's actually only costing us effectively 67% of $13 per $100 bond, which means that we're paying 8.71. So we're paying 8.71 in year 1, 2, 3, 4, and 5, and at the end of year 5, we're actually paying out the nominal value of the bonds. So putting it all into a IRR formula, rather than trying to do lots of sums, I've now been able to find that we've got an IRR of 7.47. So we've now got the value of equity, the value of debt, the cost of equity, the cost of debt, and in fact the cost of debt is worked out as the after-tax cost of debt. So I then put them into my weighted average cost of capital, the value of equity divided by the value of debt plus equity, multiplied by the cost of equity, the value of debt divided by value of debt plus the value of equity, multiplied by the cost of debt after tax. Altogether gives me a value of 10.89%. So I can go back now to my PowerPoint slides, and I can see that we've got a 10.89% return, which is the weighted average cost of capital. And if we were going to put this into a capital investment appraisal calculation, I would be recommending that you round it off to 11% just to make it a little bit easier. I hope you found this useful. If you are looking for classes in CIMA or in ACCA, then I run them in 2 different locations, one of them just outside Arundel and the other one near Brighton railway station, both in Sussex. Thank you very much for watching, and goodbye.